and welcome to this week's episode of the Riff Raff Radio Show. Today's show is going to be called the Champagne Campaign. So, what are we going to be talking about today? This episode uses cognitive bias to approach an introductory approach to investing, touching upon the layman's incentive to trade, time frame, and type of stock, primarily focusing on mutual fund and ETF markets. We describe the pros and cons of a long-term indexed investment. Later on, we relate the ideas of long-term investing and current ideas and news and media. So, let's get started. First things first, cognitive bias. So, if you were to look up the definition of a cognitive bias, this is what you would find. I found this particular definition on Google. Cognitive bias, a pattern of deviation in judgment whereby inferences about other people and situations may be drawn in an illogical fashion. So what does that actually mean? What a cognitive bias is, it's when your brain wants you to do something even though it makes no sense. So what's a good example of something like this? Well, seeing as we like talking about economics here, let's talk about it in a stock market point of view. First, people always think to buy at the time when prices are rising. So that doesn't make any sense because following this, it also means that they have to sell when prices are falling. Now, the common intuition for something like this is just to say, well, look, I want to buy low, sell high, and keep the difference. That way, I make something. Where's the sense in losing twice? If you're buying high and you're selling low, you're going to be losing money on every single investment you make. So, how do you get around this? Well, first you have to recognize that your brain wants to do something counterintuitive. Relating this to the stock market, people often get, that great tip. Their buddy says, oh, hey, I got this great stock. It's about to explode right now. Think about the Wolf of Wall Street kind of scenario. Someone tells you on the phone, oh, it's a blue chip now, but you just wait, and so on and so forth. You see, what a lot of it comes down to is an individual's person's risk aversion. So how we want to get around a problem like that is to break that bandwagon mentality. What you have to understand first is that there's a long-term growth strategy, and that if you're a person and not a computer, you're probably not smart enough to figure out exactly which groupings of data are important in every single millisecond. It's impossible to compute with a computer on something like that. So let's just talk about situations where an individual person with a few extra shekels can effectively grow for the future. So let's talk about mutual funds and ETFs. Now, a mutual fund and an ETF are very similar. In a mutual fund, you're basically buying into a fund, and in return, you're getting a certain unit amount. So you'll get a basket of goods for the price that you pay, and each time that either one of the goods in there goes up, so does your mutual fund value. But conversely, if it goes down, well, you lose a little bit of value in the mutual fund. The main difference between a mutual fund and an ETF stands for Exchange Traded Fund, for those of you who don't know, is that an ETF will pay a dividend for you, sometimes, usually. And but idea is pretty well the same. So how do you use this to your advantage in the long run? Well, before we do that, let's first find out what the average person knows already about investing. So, do you invest?
No, I don't.
And why don't you invest?
Because I have no idea what to do.
With money or strategy?
I guess with strategies, because I just kind of let my money sit in the bank.
Here's a second opinion. So is investing something that you do?
No, it's not.
Why not?
Because I guess I haven't really had the time or thought about it.
And what about somebody who does invest? So do you do any of your own investing?
Yes,
What kind of investing do you do? Long-term or short-term, and why?
I do a bit of both.
And why short?
I do short-term investing because it's better than having it in a savings account.
And the long-term, what's the purpose of that?
To ensure that I save my money.
Now, although that was a very small sample of people that you heard, you're going to have to take my word when I say I interviewed at least a good handful of each type of person, investor or non-investor. Now, the overall consensus for those who do not invest was simply that they were not confident enough in the information that they knew, or they were fearful of the information that they did not know. Now, in the market, this is something called asymmetric information. This occurs when one person knows more than the other and benefits in a trade because of it. So, to get around something like this, you can use a mutual fund or an ETF. Most fund managers will post reports as to what exactly is in the portfolio you've purchased, and they will also likely tell you about market trends, upward, downward trends, all sorts of things like that. Even though you don't understand it, at least you know you have the information. Now, for those who do invest, what we can expect from an introductory investor is that they're using it as a barrier against losing value on the dollar. Now, you might be asking, what does that mean, losing value on your dollar? Well, that is basically inflation. Each year, we know prices might go up or down a little bit, and when they increase, that is positive inflation. When overall prices decrease, that is deflation. Now, how do we relate this to the long-term investment for an introductory investor? Well, simple. You can look at an indexed fund. So, what is an index fund exactly? So, an index fund will follow a certain index, so something like the S&P 500, the NASDAQ, or any other major index for that matter. What these indexes do is they group the top performing or most trusted companies with long track records, big market caps, major players. You can think of it in that sense for the given index. So, let's use the S&P 500 as an example. So, what do we know? Well, we know that the S&P 500 has been generally following an upward sloping trend. I'll post a link to a graph for you so that you can see what I'm talking about here. But basically what that means is that on average, the S&P 500 has been increasing. So, what does this mean for you? Well, it means that the inflation rate should at least be mitigated. You know, I'm not saying every year is going to be a perfect year for you, but on average, you can expect that an index will at least match inflation. This means that you're not going to be losing value in the future for a dollar spent today. This might seem confusing, but you have to remember that there's also interest on every dollar you own or spend. So in the bank, you earn interest. Let's say if you have a really good savings account, you'll be earning about 1.5, 1.8, somewhere in there percent. And checkings accounts are usually much lower, on average less than 1%. So inflation on average is about 2%. So in a checkings account, for example, you're losing at least 1.5%. And in a savings account, you're losing, well, depending on the kind, anywhere from 0.2 to, let's say, 0.6, just to cover a good area. But if you invest, the mutual fund or ETF should be able to at least match inflation. This means that even though the price of a dollar is decreasing in present value for future terms, the index will beat the inflation so that $1 today is worth $1 in the future. This is important because a lot of people forget that value of money does not stay. Now, when talking about an index, it's very common to think about, well, what kind of companies are in here? Simple. Well, you want to think primarily about two types. So you want to know the company type, you want to know company characteristics, and I guess a third point that could be of interest for an introductory investor is market cap. So let's go from the beginning. First of all, company type. What kind of companies are in this index? Are they electronics, so like technology companies, or are they resource-based companies such as oil and gas, or are they consumer goods? Or there's there's thousands of companies out there that do this. So what kind of company are you looking for? Secondly, company characteristics. Does this company have a good track record? Does this company have a strong book value? Or what about how many assets does this company own versus how many debt obligations do they own? You want to make sure that your company is at least breaking even. But again, if it isn't an index, you probably won't have to worry about this. This is just something that your bank or broker or wherever you want to get your fund from will do for you. They'll trade for you to make sure that this doesn't happen. Now, market cap, well, you're basically going to take the value of your stock and multiply that by the amount of shares that the company has given out. So, for example, if you have a $1 stock and 10 stocks have been issued, you have a market cap of $10. Now, real market cap should exceed $1 billion, especially for a bigger company. But what's important here is that the bigger the cap, typically speaking, the more stable. Think of really big companies like Apple, who's got over 100 billion in market cap. And then you can go into really small groups where, you could get a Carlyle group or something of that nature, where it's only about a $5 billion market cap. Now, the difference in this is obviously financial pull, and the more money a company has, the more money it has to defend against shortcomings in business. This is important for the stability of the company, which could also relate back to the company type and company characteristics. So let's just recap that really quickly. Company type. What kind of industry is your company in? Company characteristics. Is your company a reliable company? Do they have a trustworthy credit rating? And market cap. How much money do investors actually think this company is worth? You have to remember all of these three factors will go up and down. No one can predict the future or exactly get the risk percentage right, so you will see a little bit of change. Maybe in a later episode, we'll talk about efficient market hypothesis, and we'll delve a little deeper into the topics of understanding what it means exactly to be an efficient market. Or if you want to think of it as an introductory investor, we can think of it in a sense of saying, how do I know that the information I know is reflected in the price? But we can leave that for a second episode. So let's link all this back to the media. Well, what do we know about the media? Well, recently speaking, I was actually reading a news article. Again, I'll post the link in the description or in the comments about Warren Buffett, and he was thinking about the next 50 years of American business. Now, if you don't know who Warren Buffett is, you should probably crawl out from under your rock or go online and read a few articles about the guy. He's done a few important things, impressive things. But as a quick recap, let's just do it up. So in 1964, Berkshire Hathaway used to be a linens company, and Mr. Buffett took it over, and he slowly started building it up. Berkshire Hathaway is now a huge conglomerate, as most people know, and it's commanding a $221,000 stock price per share. So anyways, let's talk about this. So Warren Buffett has a strong belief that if you just keep your money in what you know, and you just spend time investing in what you know, and you make sure that you are not reacting to every little bit of market information, this, that, the other thing, daily information. You need to forecast for the long run. The company you're investing in, do you think it's a trustworthy company? The company you're investing in, is it an industry that's going to have a long life, or is it more of a boom-bust industry? And secondly, market cap. The bigger the cap, more likely it's been around for a while, and it's a more trusted company. Companies like this typically don't bail overnight, so you'll have a little more confidence in purchasing these stocks that they will grow over time. Again, these are not investments you're going to be looking to make a quick buck on. This isn't buy and quickly sell. This is buy and hold on for 5, 10, 15 years. So what do we know again from this? We want to look at a stable company. We want to look at a company that is useful in the current and future period, and a company with a big market cap. So what did Warren Buffett say? Warren Buffett said, America is looking for the best 50 years coming up, and what you should do is invest in America, or better yet, invest in what you know. He's from Omaha, which is an American, a place in America. And what he said is stick to your guns, go for the long bet, and just try not to worry too much and get too involved in the fluctuation, because regardless, industry is going to grow, markets are going to grow, and that's a good thing. As long as you have an investment that can index, you should at least break even. So let us start wrapping this up a little bit here. We should highlight the importance of knowing when to acknowledge and disregard information given, and relate it to how it determines the outcome of your personal goals. So let's start from the beginning. We know we have a cognitive bias. We need to think to ourselves, I know I'm making an irrational decision, and then summon the willpower to break that decision. Secondly, you want to make sure you're going for the long run. Make sure your investments aren't sensitive to today or tomorrow's market fluctuations. Find an investment that will last. You want 5, 10, 15, maybe even longer. So that's a good time period to work with. And secondly, invest in what you're comfortable with. If you're not comfortable with anything, mutual funds and ETFs are a great option. So if you guys have any questions, comments, concerns, be sure to comment. Hopefully you guys like the new intro, and I guess we'll see you soon. Now, just as a little heads up, I plan on doing a technology show within the near future anyways, maybe next couple weeks, a month or so, looking for solar energy. If you know anything about solar, or you would like to comment, share, add a little tidbit on the show, feel free to contact me via email at radioriffraff3@gmail.com, or visit my Google Plus page at Radio Riffraff, Riffraff Radio, YouTube, Riffraff Radio channel. All the best. Signing off.